Money, business, success, it's all about perspective. Welcome to The Balanced Perspective, the podcast where we discuss all things business. Brought to you by Balance Advisors. On this episode, we have our guest, Holland Grant, the Chief Operating Officer of BISX, the Bahamas International Securities Exchange, as well as a part-time lecturer at the University of the Bahamas and a proud One family member who claims they were cheated in the last parade. As you tune in, don't forget to subscribe to our channel and follow us on all social media platforms.
But I want you to speak upon the differences between savings and investing, because I think people get that confused.
Yeah, I think people typically conflate the two. And so segregating them and explaining the difference and the functionalities of each is obviously great. And it's also trying to remove the intimidation factor from when you talk about investing, because I think frequently people get very intimidated when they hear about the term investments. They think guys in suits. Well, you see, I'm not in a suit today. Right?
Ooh,
well, you are.
They caught me today. So shout outs to the team. They did catch me today.
But it's demystifying it and talking about it. So when I think about savings, what I think about is money set aside for a rainy day. When I think of investing, I think about money locked away for a long term for a specific purpose that's working for you for that long time period, right? So when you're talking about savings, you're talking about maybe 2 months' salary so that when your car breaks down, you have money that you can unlock to get your car fixed. You break your leg, you have money because you can't work for that 2 weeks while you're in a cast and you're immobilized, right? That's savings. A nice rule of thumb is to have 2 months of salary set aside for savings. Now, truth be told, most of us don't meet that, right? Because you're using that money for other reasons, but it's a good thing to aim for.
Money under a mattress.
Yeah, basically. So that's money you'll have in a bank account whose ATM card you don't have in your wallet or your purse, so you're not accessing it as a regular. Right. But when I talk about investing, what I'm talking about is money set aside for retirement, money set aside for your child's college, money set aside because you're 22 and you're thinking that you need a down payment for a house by the time you're 27. So you're putting in money that you're expecting to grow for you for a long term, for a specific period. And that's how I would differentiate the two.
So you're at BISX, right? Can you explain for those that don't know what BISX is, right? What is BISX and how can BISX now help you to understand about investing your money?
So BISX is the National Stock Exchange of the Bahamas. So everyone used to see the commercials for the New York Stock Exchange, all of that. We're the Bahamian version of that. But realize what a stock exchange is. You don't come to a stock exchange to trade. You go to one of our members, that would be CFIL, CG Coral Isle, RF Bank and Trust, Benchmark Bahamas, Leno Bahamas. You would go to one of our members who would then trade on your behalf. And so your member would actually be the person that trades over the exchange. But they're trading on your behalf over the exchange. So BISX regulates that. What we do is we provide security. If you see a company posting financials in the paper, that's because that's a part of the BISX rules. You have to publish financials. When you see that they change a director, that's a part of the BISX rules. So we regulate the companies and give you that security that the companies are doing what they're supposed to be doing.
In terms of investments, do you recommend as an investment, let the first investment be going into the stock exchange?
That's a great question. As a first investment, I think a mutual fund is best for many people. Not all, but for many people. And the reason, what a mutual fund is, so think of it this way. You can go out yourself and buy one particular stock in one particular company. Or you can put that money in a mutual fund that buys stock in 20 companies on your behalf. So you own that mutual fund that owns a share in 20 companies. Why that's better for a first-time investor is because you have a professional manager doing that research for you. So you have the professional management, but the next thing you have is diversification. I'm sure all of us with older parents remember the saying, don't put your eggs in one basket, right? Now, I don't know if these new school grannies say that. My old school granny used to say stuff like that, right? And sometimes I actually listen. Sometimes I just played with jacks or whatever. But sometimes I actually listen. But it's crazy. Those things your grandparents said are also principles in finance, diversification. Because if you spread your risk, you're less prone to if any one investment goes. And that's the idea there with diversification. So a mutual fund allows you to benefit from professional management, diversification, but also lower costs. You could create that same portfolio as that mutual fund, but think of the time and money it would take you to do it, whereas the mutual fund's doing it for you way cheaper.
Speaking of mutual funds, a lot of investments, I I'll go back to how you said the new generation. I feel in, I may not say I feel, but in terms of the clients that we've come across in speaking to a lot of the youth, they believe that an investment will give you a quick ROI, a quick return on your investment, right? I'm going to put it into the stock market today, and tomorrow when I pull it out, I would have made $10,000 on my investment. Do you recommend, or what time frame do you recommend for people to understand that when you put an investment into something, whether it's a stock market or business, what time frame or ranges are they looking at before they see that return?
Yeah, so I'll give you a good story, Don. Um, I had a young guy. He was chopping the trees at my mom's house, and we got to talking. And he was asking what I do, and I explained. And so I was giving him some ideas on investments with government bonds that are returning about 6.5%. And he looked at me and he said, "That's it?" I had to look at him and I said, uh, that doesn't seem like a lot, but if you add that up over 30 years, that's a really nice return. But I say that to say one of the challenges I find is the fundamental, one of the fundamental rules of finance is risk equals return. The riskier something is, the higher return you expect for it. So if you're expecting your money to double in a year, realize there's also a very high likelihood that your money could go to zero within a year because risk equals return. And so you're taking on a lot more risk than you probably realize if that's what you're doing. And that's one of the areas that causes a lot of younger investors or newer investors to trip up because they don't understand that relationship between risk and return. And so, because they're promised a high return, they go into an investment not realizing the risk that they're taking.
Right.
Um, so, that's one of the first things I tell people. If you're in my UB class, I tell my students if you leave this class and cannot say risk equals return, just don't tell them I taught you, right? Um, so it's understanding that because those that misunderstand that or don't understand that well are typically those that fall victim to financial scams, so and financial fraud. What's a proper return for an investment? It depends on your level of risk tolerance. Most of us say scared money don't make no money, but you know what? Most of us also have a very low a very low risk tolerance. We say that on one hand, we say that on one side of our mouth, but many of us also can't fathom the point that we can also lose a lot of that investment.
We're not ready to risk everything on black.
We're not really ready. We just pretend like we are, right? It's gaining a better understanding about what your real risk tolerance is.
Mhm.
What's one of the things they say? Know thyself.
Yes. Know
Because
thyself.
once you know yourself, you understand what investments you should be in.
Holland, you're well rounded, right? COO of BISX, right? You spoke about being a professor at UB. The lessons that you're teaching the children, we highly commend you on that. You just talked about risk, right? What additional advice would you give, not just your students, but what advice would you give Bahamians in general, the country as a whole, in terms of ensuring that they are making the right investments for their financial future?
Well, it's a few things come to mind. Um,
This
One,
episode of the
I'm going to
Balanced
show you something.
Perspective
If you're
podcast is
making
brought to you
minimum
by
wage,
Balance
you are
Advisors.
not yet in
We
an
keep
area where
your
you should be
business
thinking
in
about savings
balance.
and investing. What you should be thinking about at that stage is how do I develop myself so that my income can increase. One of the first one of the first mental uh, one of the first things you should think of is the fact that you need to be a lifelong learner. Lifelong learning development needs to be a part of everyone's frame of mind. Because you could be the best chef in Nassau, but you're not competing with Nassau anymore. You're competing with the world. So continuing to develop yourself and never resting needs to be a part of your mental framework. The next thing that comes to mind is delaying instant gratification when it can benefit you for the long term. So the one thing that many of us do is we make decisions that yourself 20 years from now is looking at you and sucking your teeth and saying, now, why did he or she do that? Right? Um, do you need a 2025 Mercedes? Or can you make it with just a 2020 Kia?
It looks good though.
It does look good. But that's money that you could be putting into real estate. That's money you could be putting into investment. And so deferring some things that are nice now, but when that money you can invest for your long term is one of the things that I wish many of us would pay attention to. I worked like as a young boy with an uncle. He was self-employed. And I kept on asking him because my parents talked about it. Are you making national insurance contributions? And he never did. Those were decisions that he now regrets. But at the time, he preferred to spend that money in the moment. And these are decisions that a lot of us make in a lot of things that really, if we thought about it and thought, well, what would Don 20 years from now say? What would Holland 20 years from now say? What's best for him? Because remember, you may say you're only living for today. You're not. Life expectancies have certainly lengthened, and you need to be living for yourself for 20 years from now.
Yes, agreed. So Holland, with all of that, you just said 20 years from now. I don't want to have a regret 20 years from now. I hope that in 20 years, that 20 years version of me is proud of what I'm doing now.
It's grateful for what you're doing now.
Very much
Yeah,
so.
yeah.
What age would you say you would want someone to start or learn about the difference between savings and investing? When should they start? So, you're not 40 saying 20 years from now. At what age would you recommend them getting into some form of investment?
Well, it's funny. Our parents started us when we were 3 or 4. When did you get your first piggy bank?
Oh, I think around about 4 or 5. I
Yeah,
got my first piggy
yeah.
bank.
So
Yeah, you had to put the coins in it at end of day from school. I do applaud my mom. She did a really good job. Me and my brother and I, to make sure that savings was a big thing.
a lot of these lessons should start as early as possible. Hey, Johnny, you have $2. Do not spend both dollars now because you're going to need $1 next week as well. So starting these lessons earlier is better because, you know, we still end up with adults that don't understand about saving for a down payment for a house, right? We have people that don't understand, hey, if this money in a savings account earns 0% interest, but if I put it in a government bond, I could be getting 5% a year and getting dividends off of that money. The lessons like this can start earlier because the earlier they start, the more time they have to accrue, right? And the earlier kids can start learning about savings, investing, and a lot of those just basic financial principles, the damage of consumer credit when it's unneeded. I'm not saying payday advances are never needed, but they're certainly not needed as much as they're used, right? And that can be damaging to your long-term financial health as well. So the earlier we start these lessons, the better for us as a society.
Early adolescence, education is key. I love how you said that the knowledge accrues just as your money does. The knowledge accrues.
Yeah.
Olin, thank you so much for coming down, talking to us, letting our audience understand the difference between savings and investing. I hope they took plenty of notes because I got plenty of little nuggets. Some I knew, some you expanded on. Appreciate it. Look forward to you coming back on our show. So, if any of our audience have any questions, we could definitely have them answered. Thank you for joining us at the Balance Podcast. Look forward to seeing you again.
All right. Thank you.
Thank you, Wally.
Thanks for tuning in to The Balanced Perspective. Don't forget to follow us on social media at Balance Advisors 242 for more insights, updates, and expert tips. And remember, a new episode drops every Wednesday. Until next time, stay balanced.